Shut up and sit down.
All right, everybody, welcome back to Rebel Trading Group Podcast, episode 35. It is Wednesday, my dudes. Today's date is August 22nd, 2018. Like I said, it is Wednesday. What is up? My name is Nathan Oliphant, and with me, as always, is the gluten-free Jason Bessing.
The gluten-free Jason Bessing. What's going on, Nathan? We are live. I'm in the middle of a storm from hell. You can hear it. We were just talking about it. It is scaring the crap out of me. Dogs are freaking out, and you gotta love Florida, man. And it's gonna be over in like 20 minutes. That's the best part. But how you doing, man? Doing good?
I'm okay. Yeah. How are you? How is everybody?
I'm doing great, dude. I had a great day. I had an 8% gain today.
Nice.
So, we had a very sideways day across the market, kind of a mixed market. Dow Jones down 88 points, NASDAQ up 30, S&P down a point. So little to no movement. Most of the action kind of happened in the afternoon, where the Dow took the most of the dip and SPY and S&P rose just a little bit. Let's go on over to cryptos. Bitcoin currently trading at $6,338. She had that. Did you see that crazy ass rally last night? I was like literally brushing my teeth to get ready for bed, and my coins went up like 8%. It was great. Like as I was watching it, and you just go back and you see right around 7 p.m. August 21st, boom, you just see this huge rally out of nowhere. And of course, we sold off from that, but I locked in some profits, downsized a little bit, and kind of reset the board after that nice little spike there. So,
what's Bitcoin at?
I got 6,337.
So S&P hit. I guess we can go straight into news with
but
your boy Nate. So what we got going on right now is well, let's go start off with S&P hit record highs again.
Yes.
We were down today though, weren't we? Like 0.0.
A little bit.
0.04 it says, yeah. Love it. Yeah. Other big news, what's his name? Michael Cohen pled guilty to 8 counts of something. I think his new thing is campaign finance, what do you call it?
He illegally contributed too much money as that was allowed for a person of his stature, I guess.
Yeah.
I didn't look too much into it. Politics isn't really my thing. That's a you thing.
Yeah,
that's why I got you here.
Well, I didn't look at the story, so I haven't read much into it. I gotta look at things. Sorry. So post a link to that.
To me, that's not enough to really impact my market.
You thought it was going to.
I figured it could, but I was thinking about it more. I was like, what's really going to come of this? Point more fingers at Trump. I was like, by the time all this is said and done, Trump's going to be out of office.
What do you need? You need tariff talk to move the market right now.
Tariff talk, yeah. You need monetary shit.
So what do you want? What do you want? You want easing somewhere and someone else to ease the other side.
He's kind of been bashing the Fed against raising rates, saying that it's going to ruin everything that we've built and everything we've come for, and they should do what's best for the economy. And so we'll see how that affects our rates in September. That'll definitely move the markets, but.
Yeah, I saw a headline today that said if the Fed says that if the economy stays on track, they'll continue with raising rates.
Hey, I'm cool with it. That can create opportunities. It's not all scary. It's just you got to rewire your thinking with
if we grow, I mean, yeah, if we continue to grow like that, I guess, but I feel like I see like a little bit of slowing, so they need to see some slowing. I feel like they don't see slowing that I see, I guess.
Mm-hmm.
I see slowing in the housing market. I feel like that's an indicator less people are spending, which I feel like is an indicator that the economy is kind of slowing down.
And wages are not increasing. Salaries are not increasing.
So.
Very interesting. Anything else really going on in the news?
You know, People are got earnings. Let's see, Alibaba's trending right now. Let's see what's happening with them. I don't know why they're trending.
Bye.
Baba. People are calling 190. Holy shit. 250 opening here.
I remember when it was sub 100.
Sub 100. Yeah, I don't see much else in the news right now. If you see anything right now, go ahead and email us at rebeltradinggroup@gmail.com. We're live right now on Twitch.
We're twitching. Twatching.
Twitch.tv/Rebel Trading Group. This is us. I see us. And occasionally my face is going to be up there. You'll see us. Someone's having a nice
Awesome.
one.
Well, Nathan, before we jump into
we're
this
also
now,
recording. Sorry, chill, relax. I know you're eager. This is an exciting episode. Yeah.
I'm excited.
We're also recording this live for the YouTube at youtube.com/Rebel Trading Group and SoundCloud.com/Rebel Trading Group and Facebook.com/Rebel Trading Group. So hit us up. Say hello to us. Send us some fan mail. Send us some corrections. I'm ready for
Send
them.
us the lovin's.
So, yeah, let's market news with Nate. Let's hear what's going on, man.
All right. Well, before we jump into today's market terminology, I thought of a fun little game for us to play. I happen to have 7 questions for you. They're very simple. They are going to be 2 stocks that are in the same sector and are close to close competitors. And off the top of your head, without looking at the charts, without looking at the fundamentals, just kind of off the top of your head in 5 seconds or less, I want you to tell me which one you're buying.
This is not your market terminology, is it?
No, this isn't. This is just a quick little fun thing I thought of for us. So, are you ready, Nathan?
Hold on.
Okay, hang on tight.
Sure, yeah, no, I'm ready.
Okay, now you are. Okay, good. All right, number 1. Can we get 80 seconds on the clock?
I can
Just
get
kidding.
yeah, sure.
No, I was just kidding. We don't have to go that fast. But all right, right off the bat, AT&T or Verizon?
I'm gonna go with AT&T.
Google or Amazon?
Oh, gross. Probably Google.
Google. Goldman Sachs or JP Morgan?
JP Morgan.
Target or Walmart?
Walmart.
Dow or S&P?
I don't know. S&P.
Energy sector, XLE, or utilities, XLU?
XLU.
And finally, Bitcoin or alts?
That's unfair.
Hey, where's it going?
Either or? Is it either or?
Yeah, you gotta pick one.
Alts. Fuck that. Alts. There's
Okay.
so much more growth in
All
alts.
right. All right.
Spread that money out like fucking butter.
All right. I like it. JP Morgan over Goldman Sachs. I like it. Ballsy motherfucker.
Government
Sachs. Government Sachs. Okay, cool. Well, I'll put that up. I'll also put Nathan's answers with that on there. I thought that would kind of be fun. Kind of makes you really think real quick, like, You picked Google over Amazon, correct?
Yeah.
Yeah. Interesting. Yeah, I tried to get some diversity in there on some of the companies. But anyway, let's go ahead and move on over to market terminology. This might be something that you can also expand on.
Where do you run down the list?
Oh, you want me to hit it real quick?
Go ahead.
Right off the top, I'm going AT&T over Verizon. I'll take Amazon.
Are we going to talk about it?
We can.
All right, why? Okay, let's do this. Let's go ahead and say yours, and then we'll talk about why, each one.
All right. I got AT&T over Verizon.
Make it quick. Why?
Google. I don't know.
Wait, no.
I know AT&T.
Okay, well then I'll tell you why I picked AT&T.
Why?
Because I like the dividend, and it's a relatively cheaper stock.
That's true.
And the dividend pays. I feel like isn't it a higher dividend? I haven't checked.
It's like 5.5%.
It's
something
nice.
like that.
And it's a dividend aristocrat, so it's been increasing its dividend.
Yeah, Verizon's kind of the same way though, but she's a little more expensive compared to her valuations.
Okay, so
I'm choosing Google over Amazon.
Why?
I feel like they have a lot more. They have a lot more that they can do, and if I'm not mistaken, they're run a little bit better. And plus, I'm a fan of YouTube, There's so much that I feel like YouTube just still has a ton of potential.
I like Google over Amazon pretty much for the same reason. It's got much more potential. I feel like Amazon's, I don't know, Amazon or Google's got like utility like everywhere.
Yes, absolutely. I heard earlier today on, I forgot which podcast it was, but they were saying that Google actually has servers in North Korea.
Hmm.
Interesting. I'll also choose J.P. Morgan over Goldman Sachs, just because it's off the top of my head. And remember, with this we weren't looking at fundamentals. If I'm not mistaken, I think J.P. Morgan might have a little bit more growth opportunity. Goldman Sachs has a humongous footprint, and I feel like they might be too diverse in what
Stinks.
they do.
Their fucking
They're
offices stink.
huge. Why
Same.
J.P. Morgan for you?
Well, my dad works there. Shout out. No. Um, I like that it's in the Dow. Goldman Sachs is not in the Dow, right?
Well,
Oh
I have to
boy.
double check. I
Are
can get you
they?
that.
Somebody
I
in
got you.
Twitch. Somebody in
I'm
Twitch.
on it.
Answer us right now.
I'm on it right now. But go.
GS. I like that it's in the Dow, regardless.
Mm-hmm.
Um,
Oh, Goldman Sachs is there,
I don't like
as
Goldman
well as JP
Sachs.
Morgan. I just feel like they're gigantic and corrupt. Gigantic and corrupt.
I feel like they've had like a bad like taint on the U.S. economy. I don't know.
Target or Walmart. I'm choosing Target. I feel
Really?
like I feel like they're very, it's a tough call, to be honest. To be honest, that's a really tough one. I feel like they're both going to do very, very well.
Walmart's
I choose
recession
Target.
proof.
True. But, I mean, have you ever walked with your girlfriend through Target?
Yes, but like, how often are you shopping at Target during a recession?
I feel like all the time. I mean, you're
What?
still going to go there and get some shampoo and trash bags and shit.
I don't know, Walmart. It's cheaper at Walmart.
Walmart's just, the parking lot sucks. Target is
Go to the
home.
garden center. Park at the
I
garden
got that
center.
card.
Nobody's parking at the garden center.
They have the debit card that gives you 5% off on everything, including gift cards. Come on. And it's a debit.
Wow.
Why are you at Walmart?
Hmm?
Why are you Walmart over Target?
Because it's 5% cheaper than Target.
Price wise?
Yeah.
I definitely know I took Dow over SPY.
Really?
Oh, absolutely. Hands
Why?
down 1%, no question asked. I'm a bigger fan of blue chips rather
Okay.
than 500.
Yeah. It's
I don't
500
really
was
care about the
valuable though.
diversity.
Yeah, I do though. That's different though. I like the diversity of it. I actually bought the S&P fund, SPY, the other day.
Mm.
Long.
I'm going. I think I'm going to go utilities over energy.
Yeah, that dividend
Um,
baby.
dividend and just the sustainability of it. And fuck, dude, alts over Bitcoin. I'll probably go alts.
For the reason of diversification. You fucking, some of those were hitting like 2,000%.
Hmm. And they have just different speeds, and I don't know. I really don't know. That's a tough one too. But yeah, I'll post that up on the comments, and
Okay.
that will be available to you. Maybe you can quiz yourselves.
What is the market
Uh,
terminology?
Today, Nathan, maybe this is something you can explain, kind of elaborate on. Today, I want to talk the simple moving average.
Hmm.
Do you use the simple moving average?
No, not really.
No. So the simple moving average, in layman's terms, you take um, there's different days you could do, but let's just make it simple. And you say you want to use the 10-day moving average. You take the closing price of a stock and you take the last 10 days. You average, and then you take the average of those. So let's say your average for the past 10 days is $5.46. Okay. The next day you drop off the oldest of the 10 days and you add on the newest closing price. Then you take the average of those. Now your average is at 548. Now if that average is moving up and you notice that it's getting higher and higher, then obviously that's a bullish uptrend. It's also a good indicator of downtrends as well. If the moving average, if the stock moves below the moving average, then that can kind of spark quicker sell-offs, and it's a very
Somebody told
simple
me,
technical analysis tool.
I've read before that when the price is above a moving average, whatever moving average you're looking at, if the price is above the moving average, the bulls are in control, and those are like buy indicators, I think.
Yep.
Right. And if it's below it, those are like sell indicators.
Mm-hmm. And so another useful tool that you can do with the simple moving average, often just referred to as the moving average, or the SMA if you're looking at a very in deep. If you take the 200-day moving average and then the 50-day moving average, and there's a convergence point into which those two graphs meet. So if the 50-day moving average breaks above the 200-day moving average, that's a strong indicator of price increase. And why is that? Because we think it does. We think that those points matter. So institutions and traders react to those indicators. And it's a great way to kind of just get a quick glimpse at a chart. Nathan, where can we go? What?
When are you using it?
I'll use it if I'm looking at a short-term trade.
Okay.
Or if I'm kind of accumulating one particular stock over a course of time.
Okay, I see
so
that.
If I say like, okay, this month I'm going to try and load up on stock XYZ, I will check out the moving averages and see if there's anything that they're kind of telling me. I personally like to look at the 10-day because you can kind of, I feel like if you're actively monitoring it, those shorter moving averages can give you like better price points as you're averaging in daily. But when you kind of get into the 200-day and the 50-day, you're getting such a broad picture.
Yeah.
Because you're getting the lowest of the lows and you're getting the highest of the highs. The 10 days kind of nicks that and it says what's been going on recently. And it's one of the simpler tools, simple moving average. It's one of the simpler tools of getting into technical analysis. And where can you go find the moving average? Where can you get this information? Where can you, other than simply looking at rather than sitting there and taking the closing prices over the past 10 days and watching it, where can you go get this information?
Well, you can look up any like charting website, like isn't YChart's a website that you can look this up, or any kind of like
Finviz.
Yeah, any kind of charting kind of website. There's lots of free ones out there, and they have options like drop down. And of course they'll display like the price of the stock or the underlying value at the time, and then they have little overlay lines that you can drop down onto the chart. And in the drop down box, there'll be like a moving averages box, for example. You drop that down and you click on the SMA, and it'll say like it'll be like color coded, like it'll be blue, or the 200 moving average will be like red, and it'll display that, and it's cool because it'll display on like whatever like time frame you have it set on too.
And then you can put on multiple and get the MACD, the moving average, convergence, divergence. We'll get into that one next time as we kind of brush into technical analysis. We kind of roll into that ball. But I wanted to talk about that one. It's a useful tool. We do talk a lot about going long and also the fundamentals of the companies that we like and the funds that we like. But you can when you have moving averages, you can start to get rid of some of the fundamentals and say, well, what's going on now? Like, I don't care about what money they made. I want to know how the stock is moving this week. So, if you have any questions, comments, concerns, suggestions, insults, or corrections, feel free to email us at rebeltradinggroup@gmail.com. That's Rebel Trading Group with 2 G's at Gmail. So, here it is, Nathan. Episode 35.
Let's go.
Options Part 2.
The
put
comeback.
option.
Oh, the put options.
The put option. Last week we talked about the call option. And just as a brief reminder, a call option gives the buyer of the call option, the contract, gives them the right to purchase a stock at a predetermined price at a date in the future. I want to buy Ford from you at $10, but I want to be able to do that in January of next year. So
what do they say? Call up for the calls and put
so
down.
you call up if you're a bull. If you think the stock is going up, you want to be the purchaser of a call option. If you are a bear, you go the other way, you will get a put option. And the simple way is calling up and putting down. Put down the phone, call it up, call up a person, put down. And the put option, instead of giving the purchaser the right to buy at a certain price, they get the right to sell at a certain price, at a predetermined price in the future. And to be honest, they act just like call options. They just go the other way. It's literally a mirror image of the call option. So let's go back to our $10 examples, Nathan.
Yes.
Let's go ahead and start it.
I'm ready.
So it's that fucking stock XYZ, man. That motherfucker, that's a volatile bitch. And you know what? We're going to trade it. And last week we were bears. We called it up to 11. Or I'm sorry.
Bulls.
Last week we were bulls. And we called it up to 11.
The red.
We called it up to 11, right?
Mm-hmm.
Well, this time it's going down. Trump felt up a 16-year-old. And now XYZ is going down, brother.
Sell everything.
And we are pretty confident in that. So we need to pick our strike price. So instead of going above the current price, we want to go below the current price. So I don't know, just to use an example, where are we going? 9? Get the 9 put?
Let's go 8.
Let's go 8.
Because it's going to be a little cheaper right now before it happens. We have it for insurance, let's say.
Correct. So we think that the stock is going to go to 8. So you will purchase into an option. And just remember, like I said last week, you have to beat into your mind that one person has the shares and the other person doesn't. Like that, you have to remember that, and that there's always a buyer and seller of these contracts. So the buyer of the put option says, hey. He says, hey. I think XYZ is going to decrease. I think it's going to go down. So
I have the shares.
The buyer of the put option usually, we'll get into that, usually has the shares.
100 shares of XYZ.
And they say, I think the stock is going down to below $8. So I would like to purchase a put option with an $8 strike price in 1 year from now.
And so what you want to happen ideally is the price to go below $8.
Correct.
So you save yourself, so you could sell that stock then, for a higher price.
So let's say the stock. So what you're saying is you want the ability to sell the stock at $8 a share, regardless of where it's at in a year from now.
Unless it's above the strike price.
Unless it's above the strike price, in which case it wouldn't be beneficial to do. So you say, hey, I want to be able to sell XYZ at $8 a share if it goes below that. So let's say in 1 year from now, at the expiration date, your put option expires and the stock is at $6. Well, you get to sell it at $8 a share. So that's like a $200 difference that you get to keep. Now, if you own the stock, put options are great insurance vehicles because it says, hey, I think XYZ is at 10 right now. I'm going to buy a little insurance because if it goes down to 8, I want out. And I want to guarantee that I can get out at 8. So you will buy that put option, and the person on the other end says, "Hey, I don't think it's going to go below 8. I will sell you that call option, or I'm sorry, that put option for a premium." But Nathan, do you always have to have the shares?
No, you can trade the premium.
So
Just
like,
like you
how do
trade
you
the
get
call premium. So if the premiums,
bingo?
if the premium's trading at like let's say so those examples are around like $5 maybe, like a contract.
Yeah. So let's say right now, just to use easy numbers,
Yeah, here
let's
no
say
yeah. So the
XYZ is at 10.
the $8 put contract, since it's the put sides of the contracts, the premiums become more valuable when the price per share goes down and reaches closer to those lower strike prices. The closer it's getting down to those strike prices down there, those are becoming more expensive, more valuable.
Correct. Because while everybody is trading the stock, say at $6, you have the right to sell it at $8.
So if I know like a merger is gonna fail, the week on like an earnings call, maybe I'll buy some put options, maybe at the $5 put, and maybe the stock goes down, the $10 stock goes down to like $5. That $8 put's gonna be in the money now for like a bunch of money. The premium's gonna
Yeah,
fucking skyrocket.
well over 200, well
Yeah.
over $2 a premium. Because remember, the premiums are expressed in maybe $2 or 5 cents, but it's always times 100.
That's very exaggerated though,
Yeah,
The
it
stock
is
could cut
exaggerated.
50%.
Yeah, it's very exaggerated, but that's just to give an example of how these put options work. So just like the call option, you don't have to actually own the shares,
Correct.
or you don't actually have to buy the shares. So you can sell your contract with that premium. So let's say, I'm going to use easy numbers here. Our $10 XYZ stock, you buy a $8 put. And let's say you got the $9 put option. So if it goes below $9, you get to sell it at $9. So let's say for that right, you pay a 5-cent premium, so $5. Okay. Now, in a week, let's say in a month, XYZ is now trading at $9.35. That premium will adjust to that movement on the downward move. That 5-cent premium now increased to maybe 30 cents or 40 cents because the likelihood of XYZ going below 9 is now much higher. So that premium increased. And because it's in times 100, your $5 investment turned into $30 or $40. So it's a great way to capture the downside. And you got to rewire your way of thinking, because it's just like a call option. You're just going the other way.
So here's what I've been doing. Here's my strategy, because I like to trade the SPY, the S&P 500. If it's trading at like day 6 or 7 of green, of being up, it's a 6 or 7 streak day, I'm probably going to buy some put options for the next day. Or for
That's
the
a good way to
next
because
week.
because when you hit now, is that because of like your pattern recognition? You realize, hey, this thing's been going up 5-6 days in a row.
It's getting
It's
hot.
going to calm down.
Think about a graph. Think about a graph in volume and trading. There's buyers and sellers, and you can tell when there's like institutional and like really big players buying and selling on the map. I call it the map, the chart. So like you can see like a big candlestick up is usually followed by a big candlestick down to kind of match a sell-off. Like they sold some profits. Like, wow, I bought a lot and the price went up. Surprise, surprise, that happens. And they'll sell it off. You'll see kind of like a reciprocal. Sometimes you'll see a reciprocal candle going straight back down. Or you'll see it like people will hold on to their money throughout the day and then sell it off the same amount. You'll see a lot of time they're called shoulders and heads. Like you'll see a head form when a lot of people buy, hold it throughout the day, and then sell it and go back to that normal price. And the price corrects back down to where it was.
Mm-hmm.
Which is normal, because like if someone's selling it, then someone's buying it, it's gonna kind of equal out. So there's got to be more volume if you want the price to go up.
And it's much easier for stocks to go down than it is to go up.
Yeah, they're heavy.
There's a lot more factors.
When it gets too heavy, like it's on day 7 of like people buying the S&P, like sometimes some emotions are going to kick in and people are going to take profits.
It always happens. It has to. 7-8 day streaks, and we've seen them. We've seen those 8-day Dow streaks back in like 2016, 2017.
It's happened this year.
300-point gains. Yeah, they happen. But eventually they gotta sell off just a little bit. Someone's gonna want to lock in. Someone's gonna want to lock in profits.
And you can buy weekly puts. That's what I'm doing now, is weekly puts.
And you can capture the downside. I think that the put option is the best way to capture downside. Period. It's the perfect hedging tool. It's the perfect way to capture downside. I don't really short. I just don't. Honestly, I'm not good at it. I'm not good at predicting whether something's about to go down or go up, because I have a different mindset when I invest. So right now I am in the process of accumulating a lot of Chesapeake Energy, CHK. So I'm buying some on the rallies. I've been depositing money every day for the past 4 days, kind of catching this rally a little bit. And in the meantime, I projected that I'm going to be buying it over the course of the next 4 weeks or so. So I bought a 1-month put option on CHK. So what that does is, while I'm accumulating it, if there is any downside, not only am I acquiring the stock at a cheaper price and lowering my cost basis, at the same time I'm capturing extra money through the drop on the downside. So I'm protecting my position as I'm accumulating it.
Mm-hmm.
And for that right, I only paid a 6-cent premium. It was $6 to give me exposure to the downside for a month. So it's a great way to just kind of, hey, I'm going to put this money here in case there's some downside. If not, great. I'm gonna get all the shares I want at the price I want. If it does happen, then at least I made a lot of money through the put, and I can use that money to buy the actual physical stock of CHK. So they're great. They're great tools to have. I like people knowing more about put options than call options. To be honest.
So there's always a sell side as well. So let's talk about selling puts.
Selling the put. Have you ever sold a put?
No. I don't like the idea about the outcome of the obligation of selling puts.
Sorry, that was a Chick-fil-A lemonade break. So, I like to be on the sell side of things. So it's a weird concept to grasp. The sell side on the call option is bearish. The buying side on the call option is bullish. Now let's take that back with the put. Selling a put option is bullish, and buying a put option is bearish. It's opposite of what it is for the buyer. So what's the asshole like me sitting on the other side of this saying? Well, let's say we looked at the simple moving average, and I say, dude, XYZ has tons of support at the moving average. Wouldn't tell me that. I just kind of wanted to toot my horn on the. I didn't do a good job. I'm sorry.
Come on, man.
Let's say I'm looking at the charts and I'm looking at volume, and I say, dude, XYZ has tons of support at 925. Tons of support. So what I'm going to do, as I say, as the stock is approaching 925, I say, you know what? I'm going to sell the 9 put. So what does the sell side say? The sell side says, I have to buy the stock from you at $9 if it drops below that. If it goes down to $6, I got to buy it at $9. If it goes down to $1, I have to buy it at $9. My goal is to sell, probably not collect the shares, and just collect the premium, because I say, I don't think it's going to hit $9 a share. There's just no way. So I'm going to sell the put, collect the premium for you, and I'm going to lock away $900 doing so. My broker will hold on to $900 to reserve my collateral on that contract.
You have an obligation to buy that now.
Now, if it falls below, now I could be horribly wrong. From the sell side, let's say I'm wrong. Stock goes down to 880, and now I got to buy it at 9. Well, I'm paying a lot more than the people in the open market now because I'm locked in through that contract. I still got to buy it at 9. But say maybe I collected a 40-cent premium.
So you get $40, and then whatever you lose from there is deducting from that premium, basically.
Correct. So if that were the case, I would buy the stock at 9. It would be worth $8.80. So that's down $20 total, but I still would have another $20 from the premium I collected.
All right, so let's say the stock now goes up.
Now the stock goes up. I'm absolutely correct. It hits like 9.10, and then we just bounce up. It never hits $9 a share. Well, now that contract is worthless by the expiration date because it did not hit the strike price. I am no longer obligated to buy your shares at 9, which frees up my $900, and I get to keep the premium that you paid for me. So if it goes up, I'm going to collect the premium. If it goes down, I'm going to have to be the one holding the dirty laundry.
Are you just hoping that, like, when you buy that contract, that like insurance, that the price is going to go up and just you're going to keep staying out of the money?
You're saying from the sell side?
Yeah.
So if you sell the contract, if you're selling the contract, most people don't want to hold the stock. They just actually are selling it to hopefully collect the premium. But what you can do is you can sell a put maybe at the money or deep in the money. So that would be something like I would sell the 12 put on XYZ being valued at $10. So selling that $12 put would, let's say, maybe be $220 or $2.20 per share premium. Because it's well above the current price. That put is well above, so there's hella premium on it. Because that gives me the obligation to buy it from you at $12. Okay, you tracking? You still with me?
Yeah, of course, yeah.
So a lot of people can take a very big bullish position. If you expect a huge skyrocket, say I think XYZ is going to go to 20 by the end of the year, I'm going to sell the 15 put. And then once the stock skyrockets past that, it's not going to be worth it. It's going to be worth everything from the sell side. It's not going to be worth anything because it's well above the strike price. It didn't fall below the strike price. So you can take a significantly bullish position by selling a put rather than buying a call.
Right. Okay.
But it is risky. But some people will use puts to enter a position at a cheaper price. So let's say I sell an at the money put. So XYZ is at $10. I sell the $10 put in a month from now. So basically it would lock up my $1,000 because I'm buying 100 shares at $10. It would lock up that 1,000, but I would collect maybe a 30-cent premium, so $30 right off the bat. And what that would do, it would technically allow me to buy the stock at $9.70 if it were to exercise at 10. So it's a way to kind of enter the stock at a cheaper price if it hits. So some people say, you know what, I'm going to sell the put on this because I think it's a good stock. I don't think it'll hit the strike, but if it does, I wouldn't mind holding it at this price. So it can give you just a little bit better of a cost basis by selling a put and holding the stock.
Yeah, so I think like that kind of wraps it up for puts. Like anything further, we're getting into like strategies, and that's due for another episode.
That's going to be next week or maybe Friday. I don't know. I could
probably do Friday this time.
Maybe. But like I said, puts at the end of the day, you gives the buyer the right, not the obligation, but the right to sell shares at a predetermined price in the future. And for that right, that person pays a premium. And if you haven't, I mean, if you're listening to this and you didn't listen to calls, then I know you're completely lost. So go back and listen to calls. And it's literally just going the other way. There's no such thing as covered puts. You don't really sell covered puts. You would sell puts from a cash position. You would buy puts either to protect the shares that you have or to capture downside on trading the premiums. So if you understood calls, you should be able to understand puts. I know it's a little bit harder to grasp because we're not programmed to buy, to think of moving to the downside. It's weird way of thinking, but I'll say it one more time. Very powerful tool to know. Are you watching anything this week, buddy?
Let me see real quick. Why don't you go first?
Oh man, you're gonna make me do that?
Mm-hmm.
Oh man. Well, I have to stick with my precious metals right now. Gold still
well.
seems to be on kind of a small rebound. Commodities are doing well. Oil is doing great. So my CHK position is actually taking off when I'm trying to accumulate a bunch of it. It's a lucky problem, but yeah, I'm gonna keep watching gold. She's not quite back to normal levels, but she is getting there. So train is leaving. All aboard. I like GDX. That's the Gold Miners ETF.
I like GLD. I like how they hold actual gold.
GLD does hold actual gold. Vaults in London. So I'm sticking with gold just for a little bit longer. Precious metals altogether. You can throw silver in there.
Are you ready?
I'm ready. What you watching?
I'm watching. I've said this before, but STOR Capital, STOR.
And why are you watching her specifically?
They keep beating earnings. They're a pretty cheap stock. I think around like 28-ish, 26-ish. I remember. They pay a nice dividend, and Warren Buffett plays them. They're nice. They're in the S&P. I don't know how big they are. I like them because they pay dividends and they're constantly beating earnings.
I like that.
Yeah.
They do pay a good dividend.
Mm-hmm.
REITs are, you got to have that mindset. I feel like with REITs, you got to have a buy and hold mindset. I don't day trade REITs. It's kind of.
Yeah.
Someone does it, I guarantee you. But to be honest, yeah, those day trade or holding REITs can be extremely powerful. The word of the day is powerful tool, apparently. Powerful tool is REITs. Powerful tool with puts and calls. And go back to that real quick. I don't think I said it. I'm not as big of a fan of selling puts because I like the price appreciation to get rid of them. I don't want to necessarily buy them and collect the premiums. Exactly. I like the idea of selling puts to take a bullish position, but I'd rather buy and then sell the covered call because you can also have exposure to collecting the dividend. And you can use the covered call with margin, but we're going to go over that all next time. Next time I want to talk spreads and spread trading.
You're thinking about how you could be using puts and call options together.
Yeah, same price, or you use
same strike price.
Do something like the same exact strike price, and you get a call and a put. So you just need some serious movement.
You flex it a bit. You flex your prices. We'll talk about it.
We're going to talk about it.
Stay
It's going
tuned.
to be fun.
This is advanced trading with Rebel Trading Group.
And you know what's funny is it's really not advanced. It's all just lingo and terminology. Puts, calls, and exercised and delayed and time decay. And
we're about to get into level 3 right next episode.
Yeah, getting into some spread trading. And then I figured we could kind of wrap up this 4-part series with our favorite strategies. Like we'll talk spreads. Maybe the last time.
Level 4 is going to be super what do you call it? Not objective, but subjective.
Super subject. It's going to basically go back to like theory.
Yeah, it's going to be like basically if this happens, it's going to be perfect. It's going to be like the perfect scenarios, and you're going to be like, oh yeah, I'm going to make tons of money. But like, there's always like a downside. I feel like these options are fucking downside. Risky as shit.
And everyone likes to trade them different because there's so many different ways you can do it. Like you can buy a stock or you can short a stock, but there's so many ways you can do options, different prices, different probabilities, different ratios on returns.
Yeah. All right.
All right, man.
Well,
Well, this was fun. I hope it was explained easily enough. I mean, we're kind of assuming that people listen to the call episode, so we didn't have to go too much into like how these all work. So,
well, let's wrap it up.
all right, man. Where can they at us?
Well, you can add us at twitch.tv/Rebel Trading Group. We're live right now. I suppose whenever I like trade, I'll go ahead and pull up. I'll maybe go mute and I'll just put on some background music and trade, and so you guys can see my trading live, see how I trade and see how I panic. So twitch.tv/Rebel Trading Group. Email us any questions, concerns, corrections, especially corrections, at rebeltradinggroup@gmail.com. That's Rebel Trading Group with 2 G's at gmail.com. Our main platform right now is YouTube, so check us out. Give us a like, subscribe, and push that bell for notifications at youtube.com/Rebel Trading Group. Also, we are on soundcloud.com/Rebel Trading Group. Our what is it, past 4 newest episodes?
Our 4 newest episodes will always be on SoundCloud.
And a
Our
full archive is on YouTube.
Will always be on YouTube.
And give us
man.
a support on Facebook, on facebook.com/Rebel Trading Group. Give us a like, comment on videos, comment what you think, comment your ideas. Let us know, talk to us. We want to hear from you.
Dope, man. Hey, real quick, I figured I could tell you now. I'm not going to be here next week, but
why?
I'm going on another cruise, man.
Of course
CCL.
You are. Of course you are.
CCL.
Thanks for the invite.
Sorry, man. Hey, man, just come join.
Oh, yeah.
Look at ticks right now. But I will be back Friday, so if we can't have anything happen next week, we can either make it happen Friday or not at all.
All right. That sounds good, Will. We'll see you
The
guys.
choice is yours.
We'll see you guys next time.
Later.